This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asian stocks set for a consolidation session with Wall Street's $16 trillion rally taking a breather. Gold edging closer to $4,000. Escalating concern in markets about the circular nature of deals propping up the AI frenzy. Oracle sinking on a report that its cloud business profit margins are thinner than estimated. Plus, Jamie Dimon tells us exclusively that JP Morgan is spending $2 billion a year on AI and expects billions more in cost savings to come. Take a look at how Wall Street fared overnight, that pullback led by tech after some buyer exhaustion creeped in, following on from a series of records on the S&P 500. And of course, among the decliners is this year's best performing megacap Oracle, that slight decline you saw against the backdrop of concerns about its margins not being up to what some in the markets are actually estimating. Now, aside from that, of course, we did see Treasuries climbing as well. And gold, you look at COMEX futures, it is past the 4K level. Spot is closing in on that level as well. But of course, when it comes to what we're seeing in US stocks, the concern of whether this breather we're seeing is something more long-term. We also heard from the likes of JP Morgan's Jamie Dimon talking about this bull market.
Look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, the jobs are what usually starts to force people to cut back and change things. And consumers spend less and companies cut back. So far, so good.
Yeah, but we are seeing those economic concerns actually spread across Asia, perhaps not in the U.S., but when it comes to New Zealand, we have seen the survey now showing that business confidence and optimism actually fell more than expected last quarter. We are expecting the RBNZ to cut rates today in order to support the markets, and the Kiwi dollar already trading at around a one-week low given those economic concerns. It was a similar picture for Australia when we saw the Aussie dollar under pressure because we had consumer confidence falling to a 6-month low. We do have the staggered open right now. Not much happening early in the session, but what we'll be watching will be, of course, Japan. And remember, we had Japan retracing some of those big gains that we saw on the Nikkei in the past few sessions. We are still at around record highs, but we'll continue to watch whether those tech stocks continue to rally. Of course, we are seeing a little bit more pessimism around Oracle today. We had seen Taiwan outperforming, so that will be one market that we'll be watching when the market opens as well. But really, it will be about the eco data and investors digesting that this week, Avril, as we are also getting the August labor cash earnings wage growth numbers for Japan, which will help decide the trajectory for the Bank of Japan.
Yeah, and to your point about some of the markets in focus, Hong Kong does come back to trading today. Let's get the setup and bring in Bloomberg MLife strategist Mark Cranfield. So we're seeing that pullback in tech. How does this play out in Asia?
Everyone's looking at the yen. Macro traders can only focus on so many things at one time. So we've had a fantastic run in equities, gold as well. But the new one this week is the yen is very much back in play. So there's a lot of attention and risk profile will be reattached to currencies at the moment. And you're seeing that start to play out. It's not just in dollar yen, but the yen across the board, all the cross rates are coming into play as well. In terms of the equity market, the earnings season in America has only just started. The quarterly earnings, the big names haven't yet come in with their numbers. They will start really from next week. And it is reasonable that when you've had such a tremendous run in that market, that investors will start to think, okay, let's actually see some hard numbers on the table. Let's see what this earnings season has to produce. The indications are probably decent because you've had a company like Honhai in Taiwan, which is a very big partner for Nvidia. His sales numbers are very good, better than expected. That sets up nicely for what Nvidia will come through later in the period as well, and the other big names. Of course, expectations are very, very high. So these companies need to deliver. They need to produce even better than expected forecast numbers. So the outlook will be very key, particularly with the AI story as well. That's all to come. In the near term, macro traders are very busy with their yen strategies.
Yeah, talking about yen strategies, what about JGBs? Because we saw a solid, or at least a more firm demand than was expected for the 30-year JGB auction, and the indications of what's that telling us about investors' expectations of the new government by Sanaya Takaichi.
Yeah, there's certainly a relief factor, and that's a global thing as well, because the long end of the Japanese curve has been derailing what's going on in the rest of the G10 markets, whether it's in treasuries, UK gilts, or even the French market as well. All been very concerned about what's happening in Japan. The reality, even if Takaichi is going to be a big spender, if she does get confirmed as Prime Minister and she is aggressive in her expansion plans, the reality is that the Japanese issuance will be more skewed towards the shorter end of the curve anyway, not the long end of the curve. Well, we've seen a bit of a negative reaction initially this week. That's partly a question of illiquidity in the super longs. There's not enough appetite for investors to continue buying in the 30, 40-year sector of the curve in Japan. It will be skewed much towards 2-year, 5-year, 10-year, that kind of duration. The medium to long-term outlook for Japan, if they do increase spending, is much more likely to be a flattening of the yield curve, where short-term rates go up in relation to the long-term. That's something to play out over time. The Bank of Japan still needs to raise interest rates, even if Takaichi's advisors are telling them that they should delay it till December rather than October. You still have this mismatch where inflation is running way above short-term interest rates. You have negative rates in Japan. That's obviously hurting the yen. That's helping to refuel short positioning there as well. All of that needs to develop, and the Bank of Japan needs to get on top of it. Eventually, they cannot stay down for too long. So there we are. That's the outlook for the curve in Japan.
The thing is, we still don't know what some of Takaichi's policies are going to look like. And all this uncertainty, not just from Japan, from the US, from France, seems to be coalescing around one trade, gold. Are there macro risks surrounding that?
There are, and positioning risks more than anything. And it wouldn't be too surprising. We'll probably see spot gold go above 4,000 and then probably come a bit lower. There are a lot of option strikes around the 4,000 mark. That's been building up. Investors, this didn't suddenly happen. We've been building towards this 4,000 mark for a long time. And if you look in the futures market especially, there are some very significant $4,000 option positions. So often what happens in a market like that is we push through a key level like that and we quickly come back because there's a big unwinding of the option expiries. That is quite a possible scenario for gold as we get close to that mark here. The bigger picture is about geopolitics, it's about low interest rates, it's about weakness in the US dollar, and no decent alternatives. The yen falling this week again undermines the haven status of the yen, which was starting to build up recently. The euro's looking really shaky because of the French politics. The US dollar has been losing traction as a reserve currency. It's still the number one, but the numbers are reducing all the time. So gold is looking better all the time as an alternative to those other major currencies. So that long-term story is probably still decent for gold, but in the very near term, 4,000 is a very key level. It would not be at all surprising if it falls a bit from there.
Mark Cranfield, Bloomberg Live strategist there. And when it comes to those gold prices, really the rally has been amazing, right? Take a look at this chart because that line in yellow just continues to surge. Gold has added about 50% this year. We know that the PBOC is even adding to its gold holdings in September for an 11th consecutive month. We have seen this record-setting rally echoing perhaps the 1970s. But it's not only gold. We're talking about metals ETFs, the mining line in yellow surpassing, for example, oil. Oil, of course, struggles with supply issues. But copper, for example, upstream tightness, shifting end-use demand, growing strategic importance in Japan, copper and gold stocks really leading by the most in 20 years. But when it comes to that gold trade, we have the likes of Bridgewater Associates founder Ray Dalio also commenting that it should make up around 15% of investment portfolio. Speaking to Bloomberg, he called the metal an excellent way to diversify risk.
When you're thinking, you're doing your asset allocation, what is going to protect your real after-tax returns so you create that optimal mix? Gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down, because the typical parts of your portfolio are also so credit dependent. So anyway, I think all of this means that there should be some piece in that of gold. If I'm making tactical bets, I don't like debt assets per se, and I would say I don't like debt assets per se, not just government debt assets, but also if you're looking, let's say, at credit or private credit, and you look at where the credit spreads are very, very low, and so for those various reasons, my tilts would be away from those things.
And toward gold.
But again, yes, so more than would be a normal asset allocation mix. But I think you have to also say, start with what is a real dollar, if you're a dollar investor, a real return asset that you're going to hold as part of that portfolio. The most of the system is dependent on credit. Equities and everything is dependent on credit. You change credit and, then all sorts of things happen. And so it's an effective diversifier as well as probably the timing seems good.
Bridgewater Associates founder Ray Dalio speaking to Bloomberg's Lisa Abramowitz at the Greenwich Economic Forum. And of course, one of the reasons that we've seen gold really gain ground has been on that safe haven trade with the ongoing government shutdown. President Trump has escalated now tensions with Congress, saying he might withhold back pay for furloughed federal workers. JP Morgan CEO Jamie Dimon told us he's no fan of shutdowns, but questioned whether they've ever had a real impact on markets or the economy.
Look, I don't like shutdowns. I think it's just a bad idea, and I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. We've had, I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
Let's bring in Bloomberg senior editor Derek Walbach for more on this. And of course, as the shutdown continues in the U.S., a lot of services could be impacted. What will be the make or break dates that we'll be watching?
Well, Shery, the make or break date that I'm watching is going to be next week. Actually, you're going to start seeing real people who are put out of work by this and who are going to work despite not getting paid actually miss a paycheck if this continues on. Now, the biggest one of these would be the U.S. military. That would come up, I think it's on the 15th. And though that sort of date is one where I would sort of look at that and say, okay, this is going to be members of the military who are on duty, many of them in foreign lands, at sea, and who have bills to pay back home that they need to take care of. And lawmakers are loath to do anything that could possibly harm service members. That is an ultimate sort of political no-no, and it just would be really, really bad, I think, both actually and also optically. So that's one that I'm really watching here. At the same time, we're starting to see, I said last week, and I say it this way, shutdowns start medium bad and get worse. And this week, we're starting to see the effects of some of this, kind of outside of theoretical in the real world. We're getting delays at several U.S. airports right now because of staffing issues, and blame is being traded back and forth, and that's all fine. But if you're trying to fly into Nashville or Chicago or Dallas or anywhere else that's affected by this, and your plane is canceled or you're 2 hours late coming home, it doesn't make a hill of beans difference who's responsible for it. You're probably sat there quite mad that it's happening, and all of this sort of anger escalates, and that's going to be putting pressure on Republicans and Democrats alike.
Bloomberg senior editor Derek Walbach there as we keep an eye on the ongoing U.S. government shutdown. But we do have breaking news at the moment. Bloomberg has learned that artificial intelligence startup xAI, backed by Elon Musk, is raising more financing than initially planned. This will include an equity investment from Nvidia to bring its ongoing funding round to $20 billion. The financing, which includes equity and debt, will be tied to the Nvidia graphics processing units that xAI plans to use in Colossus 2. Now, this is the name of the largest data center site, which is located in Memphis. And we're now learning about these new financing plans from xAI by sources close to the matter that say xAI is raising more financing than it had expected, and it will bring the funding round to $20 billion. We have more ahead on the Asia trade. This is Bloomberg.
Look, I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, well, you'll be using AI. Some to enhance it. Some of it'll be you doing the same job. You're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JP Morgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
JP Morgan CEO Jamie Dimon speaking exclusively to Bloomberg about how he expects AI to affect jobs. And of course, in the session overnight, we did see Oracle among the stocks that came under pressure. There was some concern about its margins being thinner than estimates. And in the past 10 minutes or so, we've gotten word that Nvidia is set to be one of the backers for Elon Musk's artificial intelligence startup xAI, and it's raising more financing than initially planned. So this in total will bring its ongoing funding round to $20 billion. For more, let's bring in Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, in New York for us. So this is hot off the press. Mandeep, talk to us about the significance of this financing.
I mean, look, this is huge in the context of CapEx expectations for 2026, because a lot of folks were wondering, we have had a great year in 2025 in terms of CapEx spend. What does 2026 look like? And I think this all pointers suggest we will have another strong year in terms of CapEx spend on building GPU AI data centers. And the OpenAI deals first with Nvidia and AMD, and now xAI raising more money where Nvidia is a backer, just goes to show that Nvidia is willing to put up its own money to help the build out of this infrastructure. And I think we'll probably have another strong year in CapEx for 2026.
Yeah, just the latest when it comes to the AI industry, which has included Oracle, of course, raising that debt package, $38 billion. But the question with Oracle and the concerns overnight have been the margins, right? Will all of these investments actually pay off?
I mean, look, this AI data center build out is so complex that, yes, you can procure the chips from Nvidia, the latest Blackwell chips, but to bring them online and, to have your customers, whether it's OpenAI or someone else, start using it, there is a lag. And during that lag, yes, you will have upfront investment and your margins aren't going to look great. But we're talking about, 5, even more longer-term deals here that Oracle has signed. In fact, OpenAI has signed a $300 billion deal with Oracle over 5 years. So from that perspective, I wouldn't get too concerned about the margins right now, because when you have a 5-year deal with a company, margins will improve over time if you maintain that as a customer. And so from that perspective, I think it's just initially that you're seeing the margins look thin, but over time, the margins will definitely ramp up.
And this could also be part of its pricing strategy in undercutting competitors. So maybe not so much of a concern. But what does all this mean for OpenAI, given the recent deals with AMD and Nvidia?
So those were direct chip deals. And what OpenAI is doing is getting as much capacity they can. So they are getting, capacity from Oracle Cloud, where Oracle has the GPUs deployed. They're going directly to AMD to get the chips and set up their own data centers. So OpenAI is really going all in terms of, the build out, and they're putting pressure on hyperscalers like Google and Meta and Microsoft to match that kind of capex ramp up, because they're really raising the stakes here in terms of the the AI infrastructure build out that we'll see over the next 2-3 years.
Mandeep Singh, always good to have you with us. Bloomberg Intelligence Global Head of Technology Research joining us from New York. We'll be watching those tech stocks at the open across Asia. We have more ahead on the Asia trade. This is Bloomberg.
Kiwi assets are in focus today, especially the Kiwi in terms of the currency. Ahead of an RBNZ decision, we are seeing the Kiwi heading into that central bank decision making in the lower half of the 2025 range. It is also near a 1-week low. Now, there is still this raging debate about whether we're going to see 25 basis points or 50 basis points cut from the RBNZ that's expected to lower that cash rate today. So the key question is going to be by how much? With growth starting to stall, inflation picking up. Bloomberg's Paul Allen joins us now with more. Paul, what are the arguments around the scale of monetary easing that is needed in New Zealand?
Yeah, well, let's start with that growth question that you pointed out there. I mean, the last GDP numbers were pretty horrible out of New Zealand, a surprise contraction of 0.9%. That reversed all the gains from the previous quarter. The economy's struggling. The government's been cutting spending. So when you look at things through that lens, 50 basis points of easing today looks like a slam dunk. And certainly Westpac and Kiwibank are among those expecting that supersized cut. However, inflation's been ticking up 2.7% in the last quarter, and the RBNZ only has a single mandate, unlike a lot of other central banks, and that is inflation targeting. So when you only look at inflation, there's a pretty strong case for being more conservative and leaning towards the 25 basis point end of the range. So very tough decision for the RBNZ today. Economists are split, market pricing is split, and it's probably fair to say the board's probably split as well heading into this meeting.
So what are the chances that we see another horrible quarter and New Zealand slips back into technical recession?
Yeah, that is a very real possibility, and the signs don't look good. And it was just yesterday we had a New Zealand Institute of Economic Research survey of businesses, which found that only 18% of businesses see the economy improving over the next 6 months, and that was down from a pretty low figure already of 22% the last time the survey was taken a quarter ago. Other themes from the survey: businesses see trading deteriorating. More than a quarter of businesses have let staff go, so that plays into themes of unemployment as well. So if the RBNZ had that dual mandate where they consider employment also, that could raise the odds of a supersized 50 basis point cut today. Worth mentioning also, this is the second last meeting for the acting RBNZ governor, Christian Hawkesby. Anna Bremen's going to be taking over as the new governor on December the 1st. So you might think, well, is that going to change monetary policy going forward? Well, she's on the record at her appointment saying price stability is going to be her main focus. She says once inflation's low and stable, all the other good things follow. So unlikely the RBNZ is going to change course even under new leadership.
Paul Allen there joining us from Sydney. And in trading today, we'll be watching those miners as we continue to see gold now soaring. Safe haven moves into the precious metal. This is Bloomberg. We have breaking news out of Japan. We are getting the labor cash earnings disappointing to the downside, rising only 1.5% for the month of August, decelerating from the previous month, also coming in below estimates. Account for inflation and you have real cash earnings year-on-year contraction of 1.4%, more than expected. We were expecting some easing of this data given that we got a temporary lift from stronger summer bonuses in the previous month, but it's still deceleration on a year-on-year basis as well. The key question is, what difference will this make for the Bank of Japan, given, of course, that we were expecting a rate hike this month, but at the same time, we have the election of pro-stimulus leader Sanae Takaichi putting that into question. Still, the fact that a BOJ rate hike is on the table, potentially more fiscal stimulus, we have seen those long-end JGBs take a hit. At least when it came to Japan's 30-year sovereign bond auction, demand was firm enough to bring some calm to global markets. This, as I mentioned, after the ruling party's choice of Sanae Takaichi as its new leader. Japan FX and rates reporter Mia Glass joins us now for more on this. And of course, this 30-year JGB auction was really a crucial test of demand. What did we see, and what is the outlook now for JGBs?
Right. So yesterday's 30-year JGB auction actually surprisingly had pretty firm results, despite all the caution going into it because of the election. And it really had strong demand because of that high yield level. After Takaichi's win, we saw super long bond yields rise to those multi-year highs again. The 30-year yield hit its record high since its inception. But, you know, I also don't think that investors will be super excited about JGBs just because of that 30-year bond auction until we have a bit more clarity on Takaichi's policy and whether Takaichi will be confirmed as prime minister. I would say for the outlook of JGBs, it is quite split right now. Some people are expecting the yield curve to steepen even further. Some people are saying that the JGB sell-off might actually not last that long. It might be a bit of a temporary move. And that's partly because Takaichi has appointed two former finance ministers, Suzuki and Aso, to senior party positions, and they're seen as not being too reckless regarding the fiscal policies. So in that case, the JGB sell-off might be a bit more temporary. Of course, we also have the weakening yen, which hit its lowest since February overnight. And that could also act as a catalyst for the Bank of Japan interest rate hikes in the future, which could potentially help flatten the JGB yield curve.
So what is your sense of how that is going to potentially cap the yen weakness if the BOJ hikes in order to curtail import inflation, and not to mention the potential risks about the BOJ not moving, because we know how the Trump administration, for example, yen weakness could draw their ire. We did hear from Bernstein earlier in the year about how the BOJ is behind the curve.
Yeah, I think a lot of investors are feeling that the BOJ is behind the curve. Before the election, a lot of investors were actually expecting that October might be a possibility for the Bank of Japan's rate hike. But now if you look at market pricing, there's only about 20% chance of an October rate hike. And then overnight index swaps aren't pricing in a hike until March of next year. So that could really help weaken the yen even further. You know, and then after the election, there's kind of been a mass square up in general of macro hedge funds just closing those bullish bets on the yen. They aren't establishing new bearish bets, which kind of shows that people are a bit split. They're not really sure where the yen is going to go from here. And I think the BOJ's rate hike will be really important. And I think what we should also be paying attention to is how far the yen needs to weaken for the finance ministry to really start aggressively verbally intervening. We're really getting close to those intervention levels. So that will definitely be a space to watch.
So if not a hike in October, then when are markets pricing in the next hike to come from the BOJ? And what are the factors affecting that decision? Because, of course, we have the changing government and potentially political pressure as well, right?
Right. So I think the question of independence of the Bank of Japan is really on investors' minds right now. So last year, Takaichi described raising rates as stupid, which really scared investors that she could put a brake on the Bank of Japan's interest rate hikes if she became prime minister. This time around, she's toned down her language a bit, but we'll have to see. I think investors are quite nervous that Takaichi could put a brake on those interest rate hikes, and we might not see something in October. And then one of Takaichi's economic advisors actually said that October might be too early for a rate hike. He did say that December might be the right timing. So we'll have to see if December looks good. The Bank of Japan itself, at last month's meeting, we saw that there were two board members who actually disagreed with the decision to hold rates steady. And last week we had a few board members they're in their speeches, they actually left the possibility open for October. And where the BOJ goes from here, obviously, will have huge implications for the JGB yield curve, where the yen goes, the carry trade. So it'll definitely be an important space to watch to see when the Bank of Japan is going to hike rates next.
Japan FX and rates reporter Mia Glass there joining us with the latest market expectations for the BOJ as we continue to watch Sanae Takaichi's LDP trying to, of course, shape the government. The party has attempted to quell concerns brewing within its long-standing coalition partner, Komeito. Media reports say some members of the junior party are considering a push to leave the coalition, citing the right-wing nature of the newly elected LDP leader. Takaichi has since met with Komeito to address concerns about her views. We're also watching how Takaichi administration would shape up in terms of energy policy. Bloomberg NEF thinks her victory is a win for Japan's nuclear sector, but a loss for some sectors focused on renewable energy. BNEF head of APAC research Ali Izadi is here in Tokyo with me, so great to have you in the studio. We have seen really the huge reaction on utilities after Takaichi's victory. So what are we expecting in terms of our energy policy?
Right. Thank you very much for having me. As you mentioned, we expect that she's going to emphasize the role of nuclear in the energy mix. So both focusing on increasing the number of restarts, but also looking at next generation technologies, for example, small modular nuclear reactors, as well as even fusion. On the other hand, for renewables, her past comments suggest that she's very concerned about dependence on imported equipment. And so very likely for things like solar and wind, she may not be as supportive as previous administrations.
What does that mean for Japan's emission reduction targets then?
So the 2030 emission reduction target for Japan is 46% reduction relative to the baseline of fiscal year 2013. By the end of fiscal year 2023, Japan had already reduced its emissions by about 23%. If that pace could be maintained, then it would come fairly close to that target. But that reduction that happened in that 10-year period was benefiting from both nuclear restarts as well as a relatively rapid renewable capacity addition. Unfortunately, in the coming years, we don't expect either of those trends to continue. For nuclear restarts, we expect only about 3 additional reactors to come online between now and 2030. And then for renewables, due to successive changes in policy support, the pace of additions have completely reduced. So as a result of that, it's unlikely that that target could be met. And then if you go further on and look at the 2035 target and the 2040 target, Japan would also need to accelerate decarbonization of its road transport as well as industry. And in those areas, we're not seeing much of a momentum yet.
So, Ali, what does Japan need to do to meet both its energy needs and fulfill its emission reduction goals?
So increasing the role of nuclear in the electricity supply makes a lot of sense, but this requires more social acceptance. In particular, keeping the reactors, such as the large power plant, the Kashiwazaki Kariwa, under the incumbent utilities. This makes it more complicated. Many residents of Niigata Prefecture simply don't trust TEPCO to safely restart that reactor. Beyond nuclear, Japan does need to actually increase deployment of conventional renewables. And here, I think the discussion shouldn't be so much solely focused around imported equipment. Japan should remember that it imports 100% of its fossil fuels, and that's a consumable. And actually, as a share of GDP spending on fossil fuel imports, that's a much sort of a negative hit to the economy than, for example, buying equipment, renewable equipment that will last more than 20 years. And then similarly for road transport and industry decarbonization, Japan will need to introduce policies that will accelerate, for example, the deployment of electric vehicles and electrification in industry. Those are all things that it can learn from its OECD peers. But so far, with the exception of the period of Prime Minister Suga, for example, under Prime Minister Kishida and Prime Minister Ishiba, we haven't really seen any policies that would shift in favor of acceleration of decarbonization.
Ali, good to have you in Tokyo. Ali Izadi, he's head of Bloomberg NEF APEC research. We do have more ahead on the Asia trade. This is Bloomberg. It's all about tech. In the overnight session, we had a little bit of downside pressure with Oracle's cloud margins lower than many had expected. But then Bloomberg has learned that XAI is raising more financing than initially planned to bring its funding round to $20 billion. And this includes an equity investment from Nvidia. We have seen the downside pressure in the overnight session, but this, of course, after that massive surge that we've seen. You can see that graph on the right where the semiconductor index is leading the markets higher, and its relative performance versus the equal-weighted S&P 500 nearing the highest levels since the dot-com bubble. Let's discuss all of this with Maribel Lopez, founder and principal analyst at Lopez Research. Maribel, great to have you with us. I mean, given the incredible outperformance, what's the likelihood of that this will continue, or that we could end up like the bubble, the dot-com bubble, and a burst very soon?
Well, it depends on what you call very soon. When you look at the demand as we're seeing it right now, we still see tremendous growth could happen for the next several quarters for the hyperscalers, for the chip manufacturers. So there really just is a lot of momentum to build out capacity for AI right now. And what we're really waiting for is to see if enterprise demand catches up. There are a few troubling signs, though. One of them being the very circular nature of the economy that we're seeing right now, where the people that are buying hardware are getting investments from the hardware companies that they're buying from. So it's a little hard to unpack what is actually a deal that's revenue generating and what is a deal that's based on I've invested in you, so therefore you can buy my chips, as an example.
Yeah, anything that OpenAI mentions, whether it's apps and companies related, I mean, they see a huge stock surge. And of course, we have seen the gains for AMD as well. When it comes to that deal specifically, what are your expectations on how beneficial it can be for both companies, but also the risk to the circular deals that you mentioned?
So I think the really interesting thing about AMD is for quite some time, there's been a discussion about whether or not AMD would be a secondary player to Nvidia in the market. And I think what the OpenAI deal signaled and what everybody was really enthusiastic about was, if you look towards the end of next year, you're going to see gigawatt racks that are both NVIDIA and that are AMD. And that really means that there's opportunity to run two platforms and that we'll have at least two players in the AI market. They're very specific that this was about inferencing. And the reality is what we're looking forward to in the market for future growth are enterprise buyers looking to have inferencing workloads. So I think positioning AMD as that inferencing provider for the future, which I thought a lot of us originally thought was going to be Intel in this sector, has been a really interesting play, very well executed by NVIDIA in terms of coming up with a product that was the right product at the right price to be put into the market. So I think that's what we saw there. Having said all that, it's very interesting because it's difficult to unpack how much of that is actually revenue for AMD, how much of it was a stock trade. We've seen this deal with NVIDIA. We've seen this deal with AMD. We've seen some interesting deals with Oracle as well. So all around, it's a very interesting time. But I think what we're trying to get at is we want to rely a little bit less on the market expecting actual revenue for these AI workloads to hit within the coming, say, 6 months. And we're trying to match the CapEx spend to the demand. And I think that's the big mix match right now, because we're really spending a lot of money to get AI up and running before we see the revenues of AI.
Maribel, I was about to ask you, what are you seeing among the smaller AI players, perhaps the startup ecosystem in AI investing? There's a culture of many try, many fail, but at what point is there going to be a shift from, perhaps wanting to see more in the way of AI deployment?
So I think the interesting thing about the startup economy is one of the things that I think organizations don't appreciate or investors may not appreciate is these are very long-standing deals. When people are buying a chip technology, for example, they're not just talking about buying a chip technology for 6 to 12 months. They're often looking at 3-year time horizons for what they want to invest in, what the roadmap looks like. So it's not exactly as easy for a startup to come in and disrupt at that level where we're looking at large data centers, hyperscalers, neo clouds. Where we see the opportunity for a lot of the AI startups to possibly come into is the next wave of the market, which could be centered on edge AI and physical AI. So edge AI would be something like I'm putting AI as components of hardware into, say, physical retail stores, quick service restaurants, manufacturing floors. A lot of the manufacturing floors might have more what I would call intensive physical AI needs, which may lead more to companies like Nvidia that are doing robotic-style GPUs, but could still have a tremendous opportunity for edge AI companies as well. So I think we have multiple tiers of the AI market. We've actually not seen all of those tiers come to market in a meaningful way from both a stock standpoint and a revenue standpoint.
On these different tiers, what is your sense of how players outside of the US that maybe cannot challenge in terms of large language models, in terms of capital intensive, talent intensive side of things, how can they compete?
Well, first of all, I'd say that this is a global economy. Every country is going to want and need AI. We're also looking at this concept of sovereign AI, which is AI that is designed and resident within a country. So we're seeing that as we look around the globe, for example, China has a very strong AI chip market that they're trying to promote at the moment. And we believe that that will continue on and that there will be space for that. Companies like Camericon come to mind when we think of that. So we definitely see that there's opportunity for smaller chip manufacturers, regional players to have a very healthy, robust market. We're really in the very early days. I know we've been talking about this for a while, and I know people have been excited about it for a while. But if you actually look at deployment across businesses, we're still in very, narrow deployment models now. And as a matter of fact, we're seeing a lot of negativity in the space where people are saying, oh, people are deploying AI and they're not getting returns. So until we get to a point where more people are deploying AI, they're deploying it more broadly and they're seeing returns, we still have not seen the height of the market yet.
Lots of potential. Maribel, great to get your analysis. Thanks so much. Maribel Lopez is founder and principal analyst at Lopez Research. We'll have more ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We are getting the current account surplus widening to 3.77 trillion yen. This is widening from the previous month and also coming in higher than expectations for the month of August. Also, when it comes to the trade surplus, we're actually seeing a surplus. So we're going from a deficit back to the black, and the number being 105.9 billion yen. The expectation here was also for a deficit. So the numbers coming in stronger for the month of August. But remember, the August numbers are a little bit backward looking because we had a trade deal with the United States, but the fine print wasn't there. This is also before Prime Minister Ishiba's resignation. So we'll continue to watch these current account numbers dropping here in Japan. In the meantime, let's stay here because private equity giants are seizing lucrative buyout opportunities in the country as corporate reforms nudge companies to take offers more seriously. Asia investing reporter Lisa Du joins us for more on this. And Lisa, what's behind this boom that we're seeing in private equity here in Japan?
Hi, Shery. Well, it's really a confluence of factors. For one, the yen is very weak. Many of these private equity firms are using U.S. dollar denominated funds, so everything in Japan looks very cheap. Also, private equity deals, of course, depend a lot on debt financing, and borrowing costs in Japan are very low. LBO financing in Japan is about 3-4% compared to the U.S. is at 8-9%. And thirdly, and most important of all, I think, private equity has always had kind of a cool reception in Japan, but now they're finding that many more companies are willing to, sell off their non-core businesses or even go private with them. And that's because there's a lot of corporate governance reforms in Japan taking hold, forcing these companies to think more about their share price. And so it's kind of all of these factors coming together at the same time, like kind of a push and pull factor, really, causing this boom.
Lisa, talk to us about the numbers. How much PE activity are you seeing? What kind of returns?
Yeah, so according to numbers that were compiled by the consultancy Deloitte, there's been 192 private equity deals so far in Japan in the first half of 2025. That compares to 292 in all of 2024. So we are kind of on track to really beat last year's and kind of setting new records every year in terms of deal count for private equity in Japan. Additionally, you look at, this is from Bain & Company, the consultancy, but they have compiled these figures on kind of, return on invested capital. And in Japan, in kind of over the last 14 years, actually Japan was the market that had the highest return on invested capital for investors. So really, I talked a lot before about how there are a lot of push factors for the private equity boom, but also once these private equity firms acquire these companies, they are finding it easier also to make small changes and net a very good return on these companies.
And yet private equity always has some of its critics, right? So what are some of the challenges, especially here in Japan?
For one, I think, Japan is becoming a more competitive market. Everyone has noticed that, it is a good place now to do private equity deals. And because of that, you are seeing valuations go up and, it gets a little frothy, a little bubbly, which, always makes people a bit wary. Additionally, I think exits, we have data showing that exits are taking longer. The standard is about 5 years to either, go public or sell off to another company. And that is the kind of amount of company deals in Japan exiting within 5 years is decreasing. And so these are some things that people are kind of a bit worry as the market is starting to mature and get more competitive. People worry that it won't be as a good place to do deals as before.
What are we expecting when we have a new administration of Sanaya Takaichi here when it comes to PE?
I think the short answer will be not much will change. A lot of the factors driving private equity are kind of already really entrenched. If anything, she might help a little bit because she's been shown to be a proponent of easy money, and that's kind of put pressure on the yen to be weaker and also could help with financing costs. Additionally, a lot of these corporate governance reforms that are driving companies to do more deals with private equity were, again, part of Abenomics, the third era of structural reform. And, of course, Abe was one of Takaichi's mentors, and so I think she would be very keen to kind of keep his legacy going on that.
Bloomberg Asia investing reporter Lisa Du with the latest on the private equity space here in Japan as we head towards the market opens in Tokyo. Of course, we are still at record highs and the Japanese yen continuing to weaken against the dollar. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and watching the tech sector Avril as Bloomberg has learned that XAI is getting more financing, including investments from Nvidia. But of course, will all of these AI-related investments actually pay off is a key question. And we saw a little bit of that sentiment being dampened with Oracle's margins.
Absolutely, and some of our guests have already highlighted the circular nature of some of these deals, right? So how do you ascertain the actual value to these companies?
Yeah, tech stocks want to watch in the Japanese session. Of course, we saw that upside coming from the election of Sanaya Takaichi to the ruling LDP and her comments on strategic investments. But we have seen a little bit of that paring back of that positive sentiment in the Japanese equity space. We gained ground for 4 sessions, but we're a little bit down towards the end of the trading session yesterday. So we'll be watching today as the Nikkei is really not doing much with the topics being propelled higher and the Japanese yen continuing to weaken. We're talking about the 152 level, weakest level since February, and this really losses across the board against G10 peers on expectations of perhaps more fiscal spending. Also, the BOJ potentially delaying its rate hike. We saw some data today showing the wage growth a surprise to the downside. We saw the current account and trade surplus surprising to the upside, and we're watching JGBs as we saw the 30-year auction doing a little bit better than people had expected. And of course, that was a key test of demand when it comes to investors looking at JGBs that had been hit in the long end because of these fiscal concerns, Avril.
Yeah, and we also saw overnight in the U.S. Treasuries climbing, but what really climbed was gold against the backdrop of fiscal as well as political uncertainty. Investors have been piling into the precious metal. If you look at the spot prices, they're closing in on that 4,000 level, which is already at a record. COMEX futures have gone past that. And in terms of other U.S. assets, also take a look at how we saw tech really the drag overnight. There's a lot of concern about too much exuberance, particularly on AI and Oracle, as you highlighted just there. After its margins, some think that it could actually be lower than these estimates. So tech, as you highlighted, one to watch in the session, Shery.
Right, let's head to our top story because Bloomberg has learned that Elon Musk's XAI startup is raising more financing than initially planned, including an equity investment from Nvidia. Sources now saying its ongoing funding round has now reached $20 billion. The Asia tech correspondent Annabelle Jewelers joins us now. So what do we know about this additional financing from XAI?
Yeah, it's a really significant scoop that's just been reported in the last hour or so. But, I mean, late September, so just a few weeks ago, we were talking about this deal or this fundraising as well, about how XAI was looking maybe to raise around $10 billion. That's what sources were telling us at the time. But, as I said, just in the last few minutes, it's been reported that the startup's looking to raise $20 billion. So it's doubled just in the space of a few weeks. We're also hearing that Nvidia, as you said, is going to be taking a stake in this, so that equity investment could be worth as much as $2 billion. But it is a very massive capital raise when you put it in that backdrop of what we've seen in the past few weeks. So we've just seen OpenAI investing in AMD, for instance. We've seen Oracle looking to raise nearly $40 billion to build out its AI infrastructure. Meta's been investing heavily in AI data centers as well. So that race is really on to have that compute power ready for AI. Even as you said, Avril, there are still concerns around the AI bubble being on the horizon, and also maybe the cyclical nature or the circular nature of some of these investments as well.
Belle, talk to us also about the structure of the deal because it's seen as quite unique.
Yeah, this is really interesting. So of that $20 billion, again, that sources are telling us XAI is looking to raise, about 7.5% is going to be equity and the remainder is going to be debt. Now, it's the debt portion that's actually quite complex, but what sources are telling us is that it's going to be structured via an SPV or a special purpose vehicle, and then that SPV is going to be used to buy Nvidia chips. XAI is then going to rent out the Nvidia chips from that SPV for a period of 5 years. And that is the way that we're hearing that Wall Street investors are going to be able to recoup some of their investments. So it is an interesting deal structure as well, because the debt, we understand, is going to be backed by those Nvidia GPUs, not by XAI itself. So kind of food for thought, I guess, because it could be a new playbook for tech companies that are essentially looking to decrease their debt exposure.
Annabelle, and you mentioned Oracle's debt package, right? But in the overnight session, we also saw some of those concerns about really the payoff when it comes to margins.
Yeah, this again was a very interesting story. This one came from the information. We know Oracle as a company has been on an absolute tear. We've seen a huge rally in its stock price because this is a company that's really benefiting from all of these AI infrastructure investments. But what the companies, or what the information is reported rather, is that actually, even as the company's inking more deals, the margin on those deals apparently doesn't look that great. That's what the information says. So they put out a report citing internal documents looking at the 3 months ending August, and what they said is that around $900 million in revenue was generated from server rentals, but only $125 million in profit or gross profit was created. So $900 million in revenue, but only $125 million in gross profit. Again, that's what the information was saying. As well, what they were saying was that in some cases, Oracle was losing considerable amounts of money on its rental of smaller quantities of Nvidia chips, including both new and older GPUs as well. So we didn't get a response from Oracle essentially declined to comment on this. We did see an interesting reaction, though. Again, intraday during the session, the stock was off as much as 7.5%. It did close still 2.5% lower, but there has been some sort of interesting commentary coming out as well, including from from our Bloomberg intelligence team, and they're saying that actually this rental profit story from the information maybe looks a little bit less concerning. They're essentially saying that they don't expect Oracle to make any sort of changes to their pricing strategy in the near term.
Belle, thank you so much for providing that context. Our Asia tech correspondent Annabelle Jolis for us. Let's bring in Rupal Agarwal, Senior Research Analyst at Bernstein. Rupal, great to have you with us. Belle was just talking through some of these concerns in AI investing. What are you seeing, and what is your sense of how this is fueling momentum trades? Does this have legs?
First of all, good morning, and thank you so much for having me. We actually do think that it has legs, especially if you look at from an AI in Asia standpoint. I think the AI trade or the AI exposure in Asia is relatively cheaper. We are not seeing the kind of cross-funding deals that we are seeing in US, which is creating a bit of concern, from an investor standpoint. And even if you look at from a momentum perspective, while there are pockets of risk which are emerging across certain markets, including in Asia, including in US, we are not really seeing, a broad-based risk of a reversal yet. So we do think that, the trade could potentially continue for some more time.
What about Japan and its AI complex? As some have highlighted, it is priced below its global peers. How much of a tailwind do you see?
We do think that there is a bit of tailwind, I think, on the AI front, especially in Japan, from a semi standpoint. The sector has been struggling a bit more recently. And I think with the new leadership in Japan, which is clearly more pro-growth, as well as, semis has been identified as one of the key areas, including AI. We do think that there, it will provide a bit of policy tailwind to the sector.
I mean, Rupal, I'm not sure how much of a case is here across Asia, but when it comes to the U.S. investment landscape right now, the concerns around tech are these circular deals, right? That the prices have been artificially really swollen because of money going in and out between the sort of same number of companies. Do you see that as a risk in the long term, and could that have implications for all of these related sectors and companies across Asia as well?
Absolutely. I think, the concerns are definitely emerging much more strongly in US because of the concentration risk. And you rightly mentioned the circular deals that we are seeing. While that's not happening in Asia, what I would like to flag is some of the, strong tech-driven markets, whether you look at Taiwan, whether you look at Korea, in Asia is actually at record high level of correlations with the US equities, which means that, if there is risk and if there is a reversal in the US equities led by the tech sector, we would see implications, at least on the tech-driven markets in Asia as well.
Should we be hedging then away from these big tech names, especially given that we are seeing different macroeconomic environments as well across Asia? And where would you go?
I think from the correlation standpoint, we find China quite relatively low correlated to US equities. It has its own policy-driven catalyst, which has been helping the market. China is actually seeing, after almost 4 years, a net upgrade cycle. So clearly the fundamentals are improving. Valuations are relatively cheap. So we would say, add more China. I think even India, from a correlation standpoint, tends to be much more domestically driven market. There are selective pockets within India as well, where I would say, the diversification can play out, a much better way versus, say, only the tech-driven markets like Taiwan or Korea.
Rupal, we've been talking a lot about tech, but what's also been doing well are some of these metals-related stocks. You look at gold miners, but also copper seems to be making that comeback. Do you have positioning around these trends? What are you advocating?
I think overall, from a sector perspective, we have been quite positive on the idea of the cyclical trade or the value trade. And some of these names, do are part of the value basket if you look at the broader region. Our positivity has come from the idea that we are broadly in a risk-on environment. The typical U.S. rate cut environment does help the cyclical trade in the region, and hence I would say that that has been a key focus for us, specifically when we look at from a value exposure in the region.
Rupal, thank you for your analysis. Good to chat. Rupal Agarwal is Senior Research Analyst at Bernstein. Now, we have some lines also crossing the terminal. This is in relation to the Singapore leader meeting with his Australian counterpart, Anthony Albanese. And we are hearing, among some of the issues that have been raised, of course, when it comes to Singapore and Australia, these 000 outages in Australia that have caused a number of deaths. And this is in relation to Optus, whose parent company is, of course, Singapore's Singtel. The Singapore Prime Minister saying that he expects Singtel to behave responsibly, comply with laws, and that he expects Singtel to cooperate on this Optus outage probe. We are also hearing how they discussed stepping up defense cooperation between Singapore and Australia, of course, and that they've launched or are set to launch an enhanced comprehensive partnership. And seeing there the Australian leader, Anthony Albanese, speaking. We'll have more ahead on the Asia trade. This is Bloomberg.
Japanese stocks falling for the first time in 5 sessions. A little bit of divergence with the Nikkei under pressure, but the topics still continuing to gain ground. This at a time as the Japanese yen is now topping 152 per dollar. We're seeing a little bit of upside when it comes to 30-year JGBs, though, with that bond sale that we saw yesterday, a little bit more firm than expected. Of course, we're following eco data for an understanding of the trajectory of the BOJ. We got wages rising at the slowest pace in 3 months for the month of August. Real pay also extending its falling streak. Let's discuss all of this and bring in Bloomberg economics and government reporter Yoshiaki Nohara. I mean, we have seen pretty strong data consistently in Japan recently, but the wage data seems to be under a little bit of pressure. Is this a blip or will it make a difference for the BOJ?
Well, I think that you have to keep in mind that this downside, risk materializing the wage data was mainly driven by a drop in bonuses, so which can be, volatile. But you have to see the trend here remains the same. Basically, nominal wages have been going up, but what's concerning for consumers is that real wages continue to drop, and that hasn't changed.
And all this, Yoshiaki, is going to be potentially of consequence for the incoming Prime Minister Takaichi. What are we hearing the latest on that front? Are we getting further indications of what her policies might look like?
Well, she hasn't made a major announcements about her macroeconomic policies yet, but she has, shown some signals by appointing some key officials, former finance ministers in key positions. That is a way to show that she does care about, fiscal discipline to some extent. And she's going to have to find a way that she's going to do more to help households with inflation. But at the same time, she's not going to do, a lot of aggressive spending that can scare markets, especially bond markets.
How much pressure are we expecting BOJ Governor Ueda to face, given, of course, he's now entering the second half of his tenure, and we have a new prime minister who's in the past been vocal about not wanting higher rates, although toning down the rhetoric recently?
Right. We had a nice analytical story about the first half of Governor Ueda term. And, the next challenge for him in the second half of his term is that definitely the political pressure. He hasn't faced this kind of, leadership that is vocal about, caution on the pace of rate hikes. And Takaichi has been, hasn't said much on that direction clearly yet. But everybody is knowing knows that she prefers at least a slow approach to rate hikes.
Bloomberg economics and government reporter Yoshiaki Nohara, of course, as we follow the political developments here in Japan. We're also watching political developments over in Washington with the ongoing government shutdown. President Trump now threatening to block back pay for some federal workers once the government reopens, saying some don't deserve to be taken care of. The White House Budget Office has drafted a memo arguing the 2019 law guaranteeing back pay is flawed and doesn't require automatic payment. Democrats call that interpretation an outrage and a clear violation of the law. JP Morgan CEO Jamie Dimon says government shutdowns are a bad idea, but only have a limited effect when it comes to the markets and the broader economy. Speaking exclusively to Bloomberg, he also told us a U.S. recession is a possibility next year.
Look, I don't like shutdowns. I think it's just a bad idea, and I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. We've had, I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
Where do you think we are in that bull market? Is there any complacency there? Is it underpinned by rational factors? Is there more momentum?
Yeah, look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, the jobs are what usually starts to force people to cut back and change things. And consumers spend less and companies cut back. So far, so good. There are a lot of issues out there that, the economy's got to deal with, from all the geopolitical stuff. Maybe they'll sort out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. That might be a surprise. On the other hand, there's a lot of spending. There's a lot of government spending, which is inflationary too, by the way. And so, I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the U.S.? You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because, certain people get hurt, but it could happen in 2026.
We're still, of course, in the U.S. government shutdown.
But I do think there are positives, like deregulation is a real positive, which also helps animal spirits as a positive. And, in the one big beautiful bill, there's also more stimulus that has positives for the economy, but maybe negatives for inflation. So how it all sorts out, we'll see.
When it comes to AI, which parts of the JP Morgan business are going to be most transformed by AI?
Yeah, so we've been doing AI since 2012. So people think it's a new thing. Gen AI is kind of new, but not all of AI. We have 2,000 people doing it. Spend $2 billion a year on it. It affects everything: risk, fraud, marketing, idea generation, customer service, and it's kind of the tip of the iceberg. And so, we're deploying it. Every time we meet as a business, we ask, what are you doing in AI? What are you doing to serve your people? Why can you do better? What is somebody else doing? So we're freely deploying it, and safely. We have a lot of rules and regulations in place for our own data and how we use it, et cetera.
Is it having a material impact on revenues for JP Morgan? If not now, then when?
So we have shown that for $2 billion of expense, we have about $2 billion of benefit. Some we actually can do real detail. We did this, we reduced headcount, we saved this time and money, we reduced errors. Some you can't. It's just improved service, something like that. It's like almost worthless to say what's the NPV, but we know about $2 billion of actual cost saves. And like I said, I think it's the tip of the iceberg.
JP Morgan CEO Jamie Dimon speaking to Bloomberg's Tom McKenzie at the bank's Techstars conference in London. And we've just been hearing those concerns about political uncertainty in the U.S. given the shutdown. Also tracking political developments in Europe following the French President Emmanuel Macron losing yet another prime minister. As we watch the continued fallout from that, the worry is that this political risk turns into an economic one. Certainly we're seeing that pressure coming through on the euro, and it's worth noting as well that the likes of BofA have closed out their long euro trade. Aside from that, tracking how the European Commission has proposed 50% tariffs on steel, and this is a sort of protectionist measure for the bloc's steel sector. This is twice the current rate on all steel imports, and certainly this morning we're already hearing reactions reaction out of Asia from South Korea with its trade ministry saying that it sees significant impact from this EU steel protection plan, Shery.
And Avril, also take a look at some of those copper-related stocks in the Japanese session, because when it comes to copper, we have seen that incredible rally already, upstream tightness, shifting end-use demand, and of course, the metal's strategic importance when it comes to building new AI data centers, EVs as well. When it comes to Japan, it had an extra impetus given that we have the new leader, Takaichi, talking about strategic investments around artificial intelligence, and you can see those copper-related stocks really leading by the most in 2 decades or so. We have more ahead on the Asia trade. This is Bloomberg. We're seeing a little bit of pressure on the tech sector over in Japan. Overnight, we saw some concerns around Oracle margins. Of course, the information reporting that Oracle is likely to post a disappointing profit margin for the latest quarter. We're also seeing some downside pressure when it comes to Tokyo Electron losing more than 1.5%. We saw that a U.S. House panel issued a statement saying that Tokyo Electron and other chip equipment firms have profited by helping fuel China's chip making, Avril.
Yeah, Shery, take a look at some of the other corporate stories we are tracking. Dell Technologies gained after it roughly doubled its growth estimates for sales and profit for the next 2 years. The company sees sales rising at 7 to 9% annually for the next 4 years, with earnings per share increasing 15% or more. Dell says demand for AI products will extend those higher projections at least through the 2030 fiscal year. The owner of the New York Stock Exchange plans to invest up to $2 billion in cash into the crypto-based betting platform Polymarket. Intercontinental Exchange says it will become a global distributor of Polymarket's event-driven data, which allows traders to bet on the outcomes of real-world events such as elections and sports. The transaction values the company at about $8 billion. Tesla shares fell as it introduced cheaper versions of its top-selling models in a bid to counter the loss of U.S. incentives for electric cars. The new standard versions of the Model 3 sedan and Model Y are priced at under $40,000 with less battery range and stripped features. Tesla's global sales have fallen around 6% this year. And LG Electronics' $1.3 billion IPO of its Indian unit was fully subscribed on the first day, with most of the demand coming from wealthy individual investors. The offering values LG Electronics India at $8.7 billion, making it the largest listed home appliance maker in India. The shares are expected to begin trading next week. We have more ahead on the Asia trade. This is Bloomberg. Now, as we track the continued pullback in Asia tech stocks following Wall Street's performance overnight, we are certainly seeing Japanese semiconductor-related names come under pressure. But that's not to say that it has been a good run for Asia stocks overall that not so long ago hit those record highs. And of course, we'll be watching for the Hong Kong markets that reopen today. Let's cross over to our China correspondent, Min Lo. So, Min, Hong Kong does have a fair bit of catching up, or should I say catching down to do. What are you watching out for?
Yeah, I think it's probably going to be a catch down because you can see the screen here all red overnight in the U.S. As you said, Wall Street handover was weak, right, with the tech stocks declining after the Oracle story, the cloud services revenue there disappointing. And so we're seeing the Golden Dragon down by about 2%. Yes, Chinese stocks did participate in that global tech rally on Monday to a certain extent, but the declines here are offsetting the gains that we saw on Monday. So we could be set for a weaker open today, but flip the board. We're watching Alibaba in particular because Deutsche Bank has raised the price target for this stock by 28% yesterday. But look where we are now overnight, down about 3% or so. And interesting, if you broaden it out to look at a 6-day chart. Last week, JP Morgan raised the price target as well for BABA to 45% higher. That's where we see this big spike here on October 1st. But look where we are now. We are pretty much, we have lost quite a bit of the gains last week. This is despite Deutsche Bank saying that the company has now repositioned itself as a full stack AI services company, which means that it has better chances of monetizing AI to raising its cloud services revenue as well. But a warning from our own Bloomberg Intelligence, Robert Lee, saying that markets are really overestimating the intelligence of AI. When those limits become clear, companies will probably struggle to deliver meaningful earnings upside, and they might have to reevaluate their capex spending. But shifting over to the commodity space as well, because we have seen another big beneficiary of the AI euphoria is the metal space, because that's needed to build out AI-powered electronics and data center. You can see the metals ETF really leaving the S&P in the dust here. And so we're watching some of the mining stocks that are trading in Hong Kong today. Zijin Mining, Jiangxi Copper, probably set to gain today as well.
Yeah, Bloomberg's Mimi Low there with the latest on what to expect from the markets. As we're also watching miners in Australia, because we have seen that surge when it comes to gold prices. We're talking about record highs fueled by U.S. government shutdown ongoing right now, the crisis in France, and of course that rally that it almost echoes what we saw back in the 1970s. 50% gains this year. Ray Dalio saying that gold is more of a safe haven. The PBOC adding to its gold holdings for an 11th consecutive month, and you can see it's all to do with really how the miners will also react to these price gains in the metal sector. But the precious metal rally really fueling a new boom in Western Australia's gold fields. Giants like Northern Star, Evolution are cashing in, but investors also haven't necessarily forgotten past cycles when miners overspent and then underdelivered. Bloomberg's Paul Allen explains what companies are doing differently this time amid the rising global risks and uncertainty.
I think that the difference this time is what's going on around central banks and that shift of we need to have gold in our reserves a lot more, whereas back in the last cycle it was really around the whole mining boom and therefore what was going on in low inflation, low interest rates that pushed the price of gold up, and so that was more being driven by an economic standpoint. This time it's really being driven by geopolitical tensions and the shift in the way that governments are handling their reserves, and so that's why you sort of see that structural shift that the governments are driving this price, whereas the economy was driving the other one.
In 2019, Evolution reported adjusted gross profit of about $270 million US dollars, or about 410 million Australian dollars. That now jumped to about $1 billion. It's expected to grow even further to almost $2 billion next year.
And how about on the costs front? What's that like at the moment? Power will go up because we're obviously doubling the processing, and the processing uses power. 50% of our costs are labour.
And investors are keeping a keen eye on costs this time around. When gold prices last jumped, Australia's gold miners underperformed, falling 16% in the 3 years from 2010, while the price of the metal itself rose 52%.
For more, let's go to Bloomberg's Garfield Reynolds. Of course, we continue to see that rally with, of course, the pressure on the U.S. dollar as well. But, of course, how sustainable is this will be the question.
Yeah, Shery. Well, I mean, a big part of what's going on is not just the concerns about the dollar, but the concerns about, major currencies overall. The U.S. dollar's looking a little bit better this week. That's mostly because of political tensions and how they're impacting the currencies of Japan and of France. Japan may be about to resolve its political dysfunction, but in a way that is turning the currency back towards some significant weakness, and is a reminder to investors that a sudden drop in the yen is only a couple of political headlines away. And then the same for France and the impact that's had on the euro. So when you look at that and you look at, well, gold's outperforming a bit this week, but it's in the middle of a shutdown and we don't know when that's going to end, and there are growing concerns about the impact on the US economy as a result, as well as the concerns about the impact on US institutions of some of President Trump's policies. So that's turning everybody towards gold. And part of what has made this rally so enduring is, it was mentioned in Paul's spot just now, that central banks started piling into gold some time back. And when central banks decide to shift their allocations, they're deliberate about the decision-making process and they're deliberate about the implementation. So that means you're going to have this steady demand from central banks who these days are very much in buy and hold mode when it comes to gold. That's a major turnaround for the asset in and of itself, and a major encouragement for other people, such as what Ray Dalio was saying about, you should be holding 15% of your portfolio in gold as a hedge. So if more people are thinking like that, then gold has legs to get significantly higher, even from what's already, a pretty astonishing record high as we speak.
Gaf, you talk about central bank buying. We are expecting the RBNZ decision today. We're also watching how this is playing out on FX, Aussie versus Kiwi, for example. What are you paying attention to, as increasingly we might see this going in different directions of the RBA versus the RBNZ?
Well, I mean, it's more going in the same direction. It's just that the RBNZ is going a lot faster, which is often the case. The RBNZ has a tendency to be more nimble. Its economy is more clearly in poor shape than Australia's. It needs that central bank support. So we know we're going to get a rate cut today from the RBNZ, or we're very sure. And the question is, do they go 50 basis points instead of 25 basis points? If they don't go 50 basis points, what's their outlook? How likely are they to make a series of cuts to bring the cash rate there drastically lower over the coming 6 months to a year, whereas the RBA has been sounding a lot more cautious, and some of the economic data recently certainly has investors positioning for the potential that the RBA either has finished cutting rates, or if it is going to cut rates again, that won't be until next year. So in that situation, Aussie Kiwi is likely to keep on climbing, and the Australian dollar should be showing a bit more resilience in general, partly precisely because of that gold theme we mentioned. The Australian government was just pointing out it expects gold to be the country's second most valuable export in the 12 months through June next year, because of that extreme demand for the metal, and Australia is one of the world's biggest producers.
Right, contributing to Australian revenues. Garth, always good to chat. Thank you so much. Bloomberg's Garfield Reynolds for us there. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how Kiwi assets are trading at the moment, as we see continued pressure on Kiwi stocks and the Kiwi dollar as well. The Kiwi dollar actually falling to around the 1 week low. We had a survey showing local businesses were less optimistic last quarter, and all of this, of course, ahead of the RBNZ rate decision. Let's bring in Christina Leung, principal economist at the New Zealand Institute of Economic Research. Great to have you with us, Christina. Most economists right now expecting a rate cut from the RBNZ, but of course, how much is a key question right now. What are your expectations?
It is the key question, as you say, and we very much see this as a line ball call, especially in the wake of the latest NZIER quarterly survey of business opinion, which showed that continued weak demand. And what we've seen since December last year has been that gap between firms reporting a decline in activity in their own business, but expectations of that recovery in the next quarter. However, even with that expected recovery not eventuating, what we're seeing now is that business confidence is starting to fade. So overall, it is looking to be that fairly weak story there for the New Zealand economy, which has increased speculation that the Reserve Bank will cut the OCR by 50 basis point at this upcoming meeting today. We still expect a 25 basis point cut, but we don't see anything in the latest NZIER quarterly survey of business opinion release to stop them going 50 basis points.
And the broader economy, I mean, we had a very difficult quarter for New Zealand. Could we potentially see the economy falling back into technical recession?
That's a possibility if we look at where the areas of weakness are. So since the Reserve Bank cut interest, the OCR last year, there had been the expectation that lower interest rates would support that recovery in demand. And certainly, as I was talking about, that was the expectation of a lot of firms, even though activity in their own business has been contracting. The expectation was that things would get better in the next quarter. However, that hasn't really been the case. And what we're seeing is persistently weak demand. So we wouldn't rule out the economy falling back into a technical recession. That said, though, the Reserve Bank itself has estimated that only around half of the easing that it's cut to date has come through in terms of that impact on the wider economic activity. And that reflects the fact that a large proportion of mortgages in New Zealand are on fixed term rates. So as many households reprice onto those lower mortgage rates, that is when you see more of that stimulus come through and flow across the broader economy. Now, this has been slower than expected in terms of this flow through of when we see those impact of the lower OCR come through into the broader economy. But the expectation is that we will see those lagged impacts come through later this year.
Christina, to your point about the effectiveness of monetary policy and maybe that transmission taking a while, we're still seeing an elevated jobless rate along with cost of living in the country. I mean, the extent in which monetary policy is going to help, does a broader fix need to be coming from perhaps the government slowing some of its cost-cutting measures?
So it is a very tricky balance. What our latest NZIER quarterly survey of business opinion also showed was that with that pickup in the cost and pricing indicators, it does suggest a lift in inflation pressures. So while the government and the Reserve Bank might want to provide more stimulus to the economy, that trickiness is in not wanting to reignite inflation pressures while it's providing that stimulus. So to the extent that we're starting to see some lift in inflation pressures, as you say, the cost of living still very high. That is the tough balancing act facing both the Reserve Bank and the government. Certainly things are, when we look at demand, it is still a fairly weak picture, which does suggest that some further stimulus would be welcome.
Christina, I wonder also, can we get your thoughts on, well, we have a incoming RBNZ governor who starts in December. By that time, the RBNZ might be done with its rate cuts. What is your sense of the economy she will be inheriting at that point and what her immediate priorities are going to be?
So the new governor has indicated that she'll have a laser focus on the inflation, as she would, given the single mandate for the Reserve Bank. We would expect that by the end of the year, with the substantial amount of monetary policy stimulus that we have put through in the economy and the lagged impact as many households reprice over the remainder of this year onto lower mortgage rates, those lower mortgage repayments and with more people spending, with that we would expect the economy should be in a stronger state. That is the expectation anyway.
Talk to us also about some of the economic risks in the past year, because we're also seeing broader shifts in Kiwis moving abroad. That seems to have been a trend that's accelerated. What are the risks from that in terms of having fewer workers, fewer consumers in the economy?
So when we look at what's going on with migration flows, yes, there has been an increased number of New Zealanders moving overseas, particularly across the Tasman. That reflects the fact that they've got a relatively stronger labour market. So many New Zealanders are moving across the Tasman in search of more favourable job prospects. But if we look at what's the broader migration picture, we are still having net inflows into New Zealand. So what that means is that we're bringing more people in from other countries than people that are leaving the country. So overall, while there is the risk that, for example, we have some skills, certain skills that are leaving the country, it is important to bear in mind that generally we are still net inflows, just at a lower rate than what we've normally been experiencing.
It's also been interesting, the trade backdrop for New Zealand. What have you been seeing in terms of the impact from the tariffs?
I would say the main impact is more in the second order impact, so those flow-on indirect impacts that come through from the heightened global uncertainty. What we've seen from the history of the NZIER quarterly survey of citizens' opinion is that firms hate uncertainty in an environment where they don't know what the outlook will be looking like. It makes it that much harder to commit to spending and investment. So I would say that's where a lot of those risks are, rather than necessarily the direct impact on our export demand from those US tariffs, for example. It is more thinking about what this uncertain trade policies and what that means, the heightened global outlook, uncertainty, the global outlook, and how that might impact on broader export demand.
Christina Leung, good to have you with us, Principal Economist at the New Zealand Institute of Economic Research. We have more ahead. This is Bloomberg.
Look, I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, where you'll be using AI, some to enhance it, some of it'll be you doing the same job, you're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JP Morgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
JP Morgan CEO Jamie Dimon speaking exclusively to Bloomberg about how he expects AI to affect jobs and that optimism over AI leading to those gains that we saw. $16 trillion surge from the April lows for the S&P 500. In the overnight session, though, a little bit more concerned when it came to margins, especially Oracle. There have been some heavy spending on chips and data center capacity. Will all of this pay off, of course, has been a key question. And you can see the downside across most tech stocks across Japan, Avril.
Yeah, from DMs, let's take you to emerging markets because Vietnam has just earned its first upgrade to EM status from FTSE Russell. And this is a milestone that could draw billions of dollars in new investments. Asia Equities reporter Winnie Su is in Taipei and she's joining us for more on this story. So Winnie, how big of an impact is this upgrade? How are investors assessing this?
Yeah, Avril. So like you said, it is a milestone. While it's not as significant as a potential MSCI upgrade, investors are still saying that it's very meaningful for Vietnam. And just quote unquote what we heard from analysts, it is this watershed moment for Southeast Asia when it comes to assessing its fast-growing economy and equity story. So we are seeing this as this positive step at the right direction. And investors are now expecting more foreign foreign fund flows and more liquidity for the Vietnam market, with HSBC actually estimating a potential of $3.4 billion of inflows into the Vietnam market. And it's especially important because when you look at the rally so far this year, it's mainly being driven by appetite from the retail investors. And hence, by having more foreign money coming into the market, it is likely to support a Vietnamese market with the further upside.
Is there any potential risk of sell the news, given that, of course, Vietnamese stocks have already rallied so much this year?
Yes, exactly. So that is one big concern that we're hearing as well, because when you look at the overall index, it's up some 33% so far this year versus the ASEAN market overall just up 10%. So we are seeing a bit of a stretch when it comes to the valuations. And when you look at some of the historical moves for other markets when it comes to this inclusion or upgrade, there is that sell on fact part. So we potentially might see a bit of a profit take, which is quite natural at this moment. And another risk that we might be seeing is that because of the upgrade, the market now has to compete with more mature and more developed markets as well.
Winnie, thanks so much. I guess investors will be watching out for the MSCI upgrade next. Winnie Su in Taiwan for us. Now let's take a look at how Taiwan futures have fared. We are seeing that expectation of a pullback, no thanks to what we saw on Wall Street overnight, Oracle and those reports of concerns of these margins from the tech company. And of course, Wall Street also pulled back about from the $16 billion rally. We are seeing S&P 500 futures not giving us that much direction. We're of course watching for the Hong Kong market open next. That's it from the Asia trade. We look ahead to the start of trade in Hong Kong. This is Bloomberg.